Equity market rally in China. Is this just a flash in the pan or a new investment opportunity? Surprisingly for many, the Chinese equity market was the top performer in the recent period. From September to October, in a couple of weeks, the broad market managed to rise by more than 20%, which is very unusual for a large equity market like that. On the other hand, we know that the Chinese equity market is very volatile, rising fast and then also dropping fast. And in the recent weeks, a correction has also already begun, as was to be expected after such a sharp rally. So I think the interesting question is this just one more flash in the pan, or has something changed materially, and we could be at the start of a new bull market? Let's look closer. In the first slide, you see this line is the performance of a broad Chinese equity market of the top companies that you can also buy as a foreigner in China, in Hong Kong actually, how these prices have developed since the start of the year. And you see this massive increase from September to October. But next slide, the same idea, but just a little bit longer, more history, where you see that if you look at the last years, the recent increase in prices was not that dramatic given the massive negative performance before. We are still in total in a massive bear market in China and have just started to climb up. And even worse, if you take the time period even longer, next graph, the same idea, equity market performance China, but over the last 2 decades. And you see that current equity market level in China, where prices are in China, is the same as in 2007. This is 17 years ago. So over 17 years, no increase, no price performance on the broad Chinese equity market, which is tremendous. No other equity market comes close, none of the broad ones. So this means, of course, past performance, if we were invested in this market, was not so good. The positive thing is we are not looking for past performance, we are looking where potential future performance might arise. And here I think the next slide is the most interesting in this clip. This line shows the relative performance, equity markets US and developed markets versus performance equity markets China and developing markets. So, in short, when the line is falling, the Chinese equity market has tremendously underperformed the US counterpart. As was the case in the last years, as we're all accustomed to, that's why few people are invested there. It's a very hated equity market in the West. But if you look a little back, you see that this is not naturally always the case. You also see periods where over many years, the Chinese equity market has massively outperformed. So what's the summary of all this? We strongly believe that the Chinese government will continue heavily supporting equity market economy, banking system, etc. This will not help to suddenly solve the demographic problem in China. This will not suddenly trigger a new boom in the Chinese construction and property market, which is also not needed after a bubble. This will not reduce the problem of rising tariff barriers against Chinese exports in Europe, in the US, especially if Trump becomes the next president. This will also not suddenly make disappear the risk of a Taiwan conflict, and so on and so on. These things will not go away. But we see a good chance that these measures put a floor under the market, that the housing market will not collapse further, that the banking system will be kept stable. And given the massive pessimism of investors versus the Chinese market, we see here a decent chance actually that we may enter the next years a new phase of outperformance, or at least, put it more neutrally, that the Chinese equity market has already entered a new bull market, where usually corrections happen, but they are then a buying opportunity. Still not convinced? Look at the next chart. This shows how expensive is the Chinese market versus the US market. Basically, developed markets versus developed markets. When the line is very low, Chinese and developed equity markets are very cheap compared to developed equity markets, dominated by the US market. And what you see, despite the recent rally on equity prices in China, this line is still extremely low. The gap, the valuation gap of Chinese companies is still massive. And we don't think this gap will close. There is much higher political risk in the Chinese equity market for us foreign investors. So don't let this position become too big in your portfolio. But you have very interesting companies there. So if you manage to pick out strong export leaders, strong technology leaders, and this not only applies to China, this applies to this whole Eastern Asian region, also Taiwan, Singapore, South Korea, etc. If you manage to pick good companies there, we think you have a decent chance of good performance over the next years. So have a closer look at this topic. And if you like this video, of course, please subscribe, hit the bell, and follow us with the next videos. Until then, all the best and good luck.